Good day, co-learner. I, Sudhanshu Bhatt, Assistant Professor at Sanjeevani Group of Institutes, MBA Department, would like to talk about the foreign exchange market. Now, the first question that arises is, what is the role of the foreign exchange market in facilitating international trade and investment? The foreign exchange market is a market for converting the currency of one country into that of another country. An exchange rate is the rate at which one currency is converted into another. The foreign exchange market allows companies to trade with each other even if they are based in countries that use different currencies. The foreign exchange market functions as a lubricant for international trade and investment, making it possible for companies to exchange currencies and engage in cross-border transactions. The functions of the foreign exchange market include providing a mechanism for converting one currency to another, facilitating the settlement of international trade and investment transactions, and thirdly, providing a means for hedging against currency risk. Now, how can companies use the foreign exchange market to manage currency risk? Or you could also say, what are the functions of foreign exchange market? So to answer that question, we have to understand that the foreign exchange market serves two main functions. The first function is to convert the currency of one country into another, the currency of another country. And companies can use the foreign exchange market to convert the currency they earn from their international trade and investment activities into the currency they need to pay for imports or make the payments to foreign suppliers. The second important function of foreign exchange market is to provide some insurance against foreign exchange risk or unpredictable changes in the exchange rates. Companies can also use the market to hedge against currency risk by entering into currency forward contracts, currency options, or currency swaps. This helps them to protect against unexpected changes in currency exchange rates that could also have a negative impact on their financial position. So what do we mean by hedging? Hedging is a risk management strategy that firms use to protect themselves against unpredictable changes in future exchange rates that could have negative financial consequences. When a firm engages in hedging, it is essentially insuring itself against foreign exchange risk. In the context of foreign exchange market, hedging is achieved through a variety of financial instruments. And to understand it, we have to understand three important concepts, that is currency forward contracts, currency options, and currency swaps. These instruments allow firms to lock in a future exchange rate and protect against potential losses resulting from adverse movements in the exchange rate. Now, how do we differentiate between spot exchange rate, forward exchange rate, and currency swaps? Spot exchange rates refer to the rate at which a foreign exchange dealer converts one currency into another currency on a particular day when the exchange is executed immediately or on the spot. Spot exchange rates are constantly changing based on supply and demand for different currencies and are reported on a real-time basis on many financial websites. They can be quoted in two ways: as the amount of foreign currency $1 will buy, or as the value of a dollar for 1 unit of foreign exchange currency. Forward exchange rates, on the other hand, refer to the rate at which two parties agree to exchange currencies and execute the deal at some specific date in the future. Exchange rates governing such future transactions are referred to as forward exchange rates. For most major currencies, forward exchange rates are quoted for 30 days, 90 days, and 180 days into the future, although it is impossible to get forward exchange rates for several years into the future. Forward exchange rates differ from spot exchange rates and reflect the expectations of foreign exchange market about future currency movements. The third and the last important concept is the currency swaps. Now, swaps are financial transactions in which two parties agree to exchange a series of payments in different currencies over a specific period of time. In a currency swap, the two parties agree to exchange principal and interest payments on an agreed upon schedule. Currency swaps are used to hedge against foreign exchange rate risk or to obtain lower borrowing cost in a particular currency. Unlike spot and forward exchange rates, which involve only two currencies, currency swaps involve at least two currencies and are more complex financial transactions. Now, to understand the nature of foreign exchange market, we will deliberate upon the following 4 points. The foreign exchange market is a decentralized global network of banks, brokers, and dealers connected by electronic communication systems. It has been growing rapidly due to the increase in cross-border trade and investment. London, New York, Zurich, Tokyo, Hong Kong, and Singapore are the most important trading centers, with London being the largest due to its history and location. The foreign exchange market operates 24/7 and is integrated through computer linkages, meaning that the exchange rates quoted in different trading centers cannot differ significantly. The US dollar plays an important role in most transactions, with 88% of all foreign exchange transactions involving dollars on one side. Now, what is foreign currency forecasting and the two schools of thoughts? Currency forecasting is the process of predicting future exchange rates movement. There are two schools of thoughts on whether investing in exchange rate forecasting services is worthwhile or not. The first is the efficient market school, and the second, inefficient market school. The efficient market school argues that the foreign exchange rates, which represent market participants' collective prediction of future spot exchange rates, are the best possible predictor of future exchange rates. Therefore, investing in forecasting services would be a waste of money. The inefficient market school argues that companies can improve the foreign exchange market's estimate of future exchange rate by investing in forecasting services. This school of thought believes that forward exchange rates are not the best possible predictor of future spot exchange rates, and professional forecasting services might provide better predictions. However, the track record of professional forecasting services is not always good. Now, there are two approaches to exchange rate forecasting. One is the fundamental analysis, and the second is technical analysis. Fundamental analysis uses economic theory to construct models that predict exchange rate movements. The model includes variables such as relative money supply growth rates, inflation rates, interest rates, and balance of payment positions. For example, a country with a persistent balance of payments deficit, that is importing more goods than services than it is exporting, may experience a depreciation of its currency on the foreign exchange market, as people in other countries convert their dollars into other currencies. It is suitable for long-term investors who want to understand the underlying economic factors that affect exchange rates. Now, the technical analysis, on the other hand, relies on price and volume data and determine past trends that are expected to continue into the future. This approach does not consider economic fundamentals but assumes that there are analyzable market trends and waves that can be used to predict future trends and waves. Despite skepticism from economists, technical analysis has gained favor in recent years. It is suitable for short-term traders who are interested in identifying trends and making quick decisions. Currency convertibility. Currency convertibility refers to the ability to convert one country's currency into another freely and without restrictions. A currency is said to be freely convertible when residents and non-residents are allowed to purchase unlimited amounts of foreign currency with it. In contrast, a non-convertible currency is one that cannot be exchanged for foreign currency by residents or non-residents. Governments often impose restrictions on currency convertibility to protect their foreign exchange reserves from capital flight, a phenomena that occurs when people rush to convert their domestic currency into foreign currency. Capital flight can lead to a depletion of foreign exchange reserves, making it difficult for a country to service its international debt obligations and purchase imports. External convertibility restrictions, where only non-residents are allowed to convert the currency, may limit domestic companies' ability to invest abroad. However, it presents fewer problems for foreign companies wishing to do business in that country. To overcome the non-convertibility problem, companies can engage in counter trade, a phenomena that includes a range of barter-like arrangements where goods and services are traded for other goods and services. So here we enlist three types of foreign exchange risk. First is the transaction exposure, which refers to the extent to which income from individual transactions is affected by fluctuations in foreign exchange values. This exposure includes obligations for the purchase or sale of goods and services at previously agreed prices and the borrowing or lending of funds in foreign currencies. Transaction exposure arises from the fact that exchange rates can change between the time when a transaction is agreed upon and when it is settled. The second important exchange risk is the translation exposure, which is the impact of currency exchange rate changes on the reported financial statements of a company. Translation exposure is concerned with the present measurement of past events. The resulting accounting gains or losses are said to be unrealized, but they can still be important. Translation exposure arises from the fact that a company may have assets or liabilities denominated in a foreign currency which must be translated into the reporting currency for financial statement purposes. The last foreign exchange risk refers to economic exposure, which is the extent to which a firm's future international earning power is affected by changes in exchange rates. Economic exposure is concerned with the long-run effect of changes in exchange rates on future prices, sales, and costs. Economic exposure arises from the fact that exchange rate changes can affect a company's competitive position in the global marketplace, potentially impacting its future earnings. Well, that's all for today. I hope you had learned something new and interesting. We will continue our engrossing debate and knowledge exchange on international business and foreign exchange markets very soon. Thank you very much for joining. Have a good day. Goodbye.